Hello, CFA members and guests. Welcome back to the CFA Society of Chicago's Macro Matters podcast, where we talk about all of the macro that matters. My name is Rich Excell, and I'm always welcomed to be joined by my co-host Tony Zhang. Tony, welcome. Good to see you again.
Yeah, good to see you, Rich. Hopefully the semester finished you strongly. Hope it's just as market rebounds over the past couple of days, giving the investor very strong confidence for the rest of the summer. We'll
Yes,
continue.
I know you're absolutely right. And then the semester, I hope that semester ended well for you as well.
Yes,
It is
yes,
always interesting. Like I'm talked about this week, is it the end of the beginning or the beginning of the end?
yes,
We're end of the semester, but it's also the beginning of the summer. And so
correct.
there's always mixed emotions on both of those fronts. But you're right, from an investor standpoint, we were talking before about whether or not we would see a sell in May
Go
reaction
away.
because of potentially because of the Fed not cutting rates anytime soon. And that's certainly what we saw from the Fed. And I've got some slides I want to show and we can go through those. But we certainly heard that in May 1st. Some people were actually asking the Fed if they were going to hike rates, and they said
Hmm.
no, but they also don't sound like they're going to cut rates anytime soon. However, earnings have continued to be pretty good, and that's bolstering stocks right now. And we also got a weaker than expected jobs number, and that's got people thinking that perhaps a cut is in store for us a little bit, but we shall see. But I wanted to go through some slides and kind of get your opinion on these slides, Tony, and just some things that I'm thinking about as we kind of go through. So let's see. Whoop, sorry. So here we go. So the first thing I want to show you about it, kind of along the same lines as that weaker than expected jobs numbers, the collectively, I look at the City Economic Surprise Index. That's the
Hmm.
white line here that we're looking at. And this measure, we've talked about it before, but what it doesn't really show the absolute level of the economy, strength or weakness, but what it shows is where the data is coming in relative to expectations. And so it's very mean reverting data point. It oscillates essentially around some positive number. But what it's really showing here of late is that while the economy had rebounded a little bit early part of the year and people were thinking that data was better than expected, in the month of April, it wasn't just the non-farm payroll number, but really in the last couple of weeks of April and early May, the data has come in consistently much worse than expected. And what I have it plotted against here is the two-year Treasury note, two-year Treasury note yield, and that, as you can see, it's a pretty good fit. So when the data is better than expected, the market is thinking that there's going to be fewer cuts, and so the two-year yield heads higher. And when the market thinks that data is worse than expected, they think the Fed's going to cut more aggressively, and the yield heads lower. And what we've seen here is that the yield is still kind of hanging out around that 5%-ish level, because I think markets in some ways focus on the Fed higher for longer. But if you're looking at just what the data is telling us, it's suggesting that yields should be quite a bit lower. Is that kind of how you see it, Tony?
Definitely, Richard. If we actually recorded from the beginning of this year that we both agreed the market was over optimistic about the path the Federal Reserve is going to take in terms of their monetary policy. And even by the end of today, the market still anticipated then there will be actually a two cut by the end of this year, which you actually did not anticipate any cut. And I would say there might be only one cut in June. And now the market anticipated that it will be postponed to September, which I don't think it could be the case. So Federal Reserve really have to just take a one stance here in June, or either they do not take any action just before the election, and none of the Federal Reserve actually want to actually put their foot wet before the presidential election, which is actually one of the most important events like in this year, right? If we still record that in year 2020, right before the election, or post the election result, that we see the huge market volatility minus the positive 5%, even in the index future change, if you still recall it.
Yeah,
So
absolutely.
yeah, so here apparently Federal Reserve doesn't want to do that. Now, market definitely suggests, based on the economic data, we did especially recent PMI data, job growth rate data suggests that Federal Reserve could actually lower the interest rate slightly. This actually received some support from multiple data in terms of yield spread, and simultaneously from the I think the employment data. Apparently, the employment data actually hasn't really grown up as significant as it was at the beginning of this year. This is definitely have some kind of support over there. However, as what we discussed in the past couple episodes of Macro Matters, the inflation remained resilient, and the inflation was actually caused up by the hiking price of the commodity. So any commodity-driven inflation will not just go away easily. Oh, it won't. And it would actually stay here for quite a long time. And Federal Reserve does have the responsibility to actually, one of their mandates, two mandates, is to actually to control the inflation. If they actually adhere to what their mandates should be. Now, this will be exactly the case. They might actually try to hold the interest rates as at this particular level until the inflation actually decrease or sits down. That's actually what we have seen. So from we do see some divergence in terms of macroeconomic data, and this is also being reflected over the market internals as well. This is just how I think, Rich. What do you think?
Yeah, I would agree with you. I think that and I have some slides to talk about both the mandate and how I think that we might, in spite of the fact that Jay Powell said in his press conference that he doesn't see any stag or any inflation. I think I'll show somewhere. I think we might be seeing some stagflation because when we're talking about the data coming in worse than expected, that means that growth is disappointing to the downside and inflation is disappointing to the upside. And so that combination suggests to me we might be seeing some stagflation. But the second chart that I have here is just exactly what you're talking about in terms of what's the market's pricing in. And if we look back to April 30th, before the Fed meeting, before the jobs data, we can see that really we were pricing in only one cut for this year, and it wasn't until December. And what we can see now is that we're pricing in almost close to two cuts into December, with the first cut some September November period. And I agree with you, around the election, that's going to be pretty difficult for the Fed to navigate that.
Correct.
The Fed says it's not political, but we both know that I think the Fed doesn't really want to do anything near the election unless it absolutely has to. So it would be surprising to me for them to do some sort of insurance cut, just to say that they did that. So I think this the market is really kind of suggesting that if anything, we may see a cut towards the end of this year. But that's kind of where it is. But kind of back to that Fed mandate. And so this is a chart that I have here, and because I was having a debate with somebody online about this, about whether the Fed would cut, and I was kind of making the same point that you were, that the Fed has a dual mandate, right? Price stability and full employment. And if we look at the jobs numbers, yes, they were worse than expected. Yes, the unemployment rate has moved up to 3.9%, which is 0.5% above the lows that we saw back in 2023. However, the 3.9%, if we look in absolute terms, is still one of the lowest readings we've seen this century. 3.9% is very, very close to full employment. And so it's hard to argue that you would cut rates when the unemployment rate is below 4%. However, the inflation is stubbornly high. And so what I've done here is simply created a very simple index that I call Fed mandate. And what it does is it divides CPI by the unemployment rate. I know there's a number of different ways we can try to measure inflation. I know there's a number of different ways we can try to measure the employment market, et cetera. But the CPI and unemployment are really the two that the market tends to focus on. And so if you just take the two of them and you divide them, what you see is that when that measure is moving higher, that means that inflation is a bigger issue than the jobs data. And when that measure is moving lower, that means that inflation is falling relative to the unemployment rate. And if you plot that then versus the Fed funds rate, which I've done here, you can see that it's actually, I would it's not a tight enough fit that for a quantitative investor like yourself, you probably wouldn't do anything quantitatively, but directionally, you can see that it's a pretty good fit, right? And I think what
Yes.
I've also tried to draw here, with a vertical line, I just put around 2000, but you could really put that line somewhere probably in the mid 90s, is try to show that I think that the reaction function of the Fed via the discount rate, and what that line is telling us can tell us where, if we look in the 70s, 80s, and early 90s last year or last century, the Fed was more hawkish, right? They were trying to stamp out inflation. And what I'm saying by that is that when the line was moving higher, when inflation was moving higher relative to unemployment, the Fed was very quick to react, to move rates higher and move that rates even higher than that line was suggesting. And when that line was falling, suggesting inflation was falling, the Fed was very slow to react to move rates lower. So the Fed was definitely keeping rates higher for longer and being really quick to raise them to try to stamp out inflation. And this is the Volcker Fed that everyone talks about that really crushed the back of inflation. Fast forward to Alan Greenspan and then Ben Bernanke, Janet Yellen, and now Jay Powell. And what you can see is what I would call a dovish Fed. And then what that means is that when this line is falling, the Fed is very quick to cut rates. They have an itchy trigger that they really want to cut rates very, very, very quickly. And when this line is rising, inflation is moving higher than unemployment is. The Fed is very slow to raise rates, and so this tells me that the Fed, for the most part, this century has wanted to keep rates lower than it otherwise should. So it's very, very dovish Fed. It's the Fed put, if you will, the Fed put that we've gotten so used to in the asset markets. And now, if I look at that Fed mandate line, it's still hovering somewhere around one, right? We've got about 3.6% inflation, 3.9% unemployment. And so, if we look at where it came, if it was well above two, it was back to those levels we saw in the 70s and 80s not too long ago. So even though the Fed has raised rates quite a bit, if they were as hawkish as they were last century, they actually should be raising rates even more than they have so far. And so
All
the
right.
fact that people are talking about them cutting rates when this line is not moving lower tells me that I think the market expecting rate cuts, that's where one of the another reason why I think that the market is really a little too optimistic for that Fed put for the Fed to cut rates, because I don't see in their dual mandate where they should be cutting rates right now. I don't know how you think about that.
Yeah, Richard, by the way, this is a very interesting graph. That's something that I have been thinking about in the past, and this actually is telling the investors a lot of information. That's what you have shown from the left-hand side to right-hand side, moving from a hawkish Fed to the dovish Fed, as you really pointed out that it started with the Volcker Fed. I mean, during which time that I think the Fed really actually holds the interest rate extraordinarily high to counter against the high inflation. And it was actually for one of that reason. And apparently there were so many reasons why the U.S. market is becoming a leading market in the world, and U.S. dollar, U.S. currency has become the leading currency in the reserve currency in the world. I think is um, uh, Chairman Volcker contribute that significantly by upholding the confidence that for the rest of the global investors over Federal Reserves, the adherence to their mandate. Because if it is just purely for the countries, I think for country or for Federal Reserves, like own reputation wise, that Chairman Volcker has many reasons to actually to cut the interest rate, to actually to stimulate the economy, and simultaneously not taking too much of responsibility for himself. And it was actually because that he continued to hold the interest rate so high for a long time to really temper the inflation, to actually gain the confidence for the rest of the world of the investor that Federal Reserve can actually might be running independently and might not be interference like from other political issue. That was one of the major reasons. I think so. We accredit to Volcker, certainly for sure. And as what you have seen, starting from the burst of dot-com bubble, year 2000, then we start to see the very like easing monetary policy continuously going on, and it wasn't until the recently, I think last year, that we started to see the Federal Reserve started hiking interest rate at a 5.2% to really trying to restrain the inflation from going too high. However, there's were so many reasons that why the inflation remains so high. We have been discussing this for a long time. So for maybe audience, they can continue to go back and watch our past episodes, right? So there's just so many reasons for. But what we are looking forward here, starting from now on, apparently Federal Reserve has still had a two choice whether they can adhere to their mandate or not. This is still two things, because as what you really point out right now, the unemployment rate is still in a historical low regime. This is extraordinarily good. So Federal Reserve has all of the reason to continue to hold the interest rate slightly higher for longer, to actually trying to temper the inflation. They could do it. They have the flexibility, and thanks for the strong economy, which of the U.S. Now, with given the continuously strong employment data within the U.S., we still see the upper growth of the wage. That's actually a predictive indicator of the U.S. labor market than any other data. So this is still telling us that Federal Reserve at this moment still taking a very cautious step and approach going forward. And as what you have seen in the previous slide, that people market actually priced in that there will be one cut in November, which we neither of us actually believe will be the case. Is that they will not actually step get into taking any action just right before the election. This is no way. Even though I agree with you that Chairman Powell saying that the Federal Reserve will actually make a decision independently or without any interference politically, but we all know that isn't the case. This is definitely they won't actually take any action. They have the flexibility to actually wait until maybe right after the election. So I definitely think at this moment Federal Reserve's approach or stance remain very strong, and I think this could be appropriate.
Yeah, I would agree with you. And on that wage front, and it's something I wrote about in my LinkedIn post today, which I don't have a chart here for it, but what it talked about is really, if you talk about the inflation that people care about, it's really three things. It's housing, it's healthcare, and it's education are what people really are concerned with most. And on each of those fronts, whether we look over the last 10 years, over the last 20 years, however you want to look at it, um, all of those have run much hotter than the CPI, and they've run much hotter than anyone's incomes have. And so the housing, has been going up on the order of about 2.5% a year, whereas CPI over that longer period of time has been somewhere just under 2%. Same with incomes. College tuition, and not even including the cost of room and board, has been going up even faster than that, just under 3%. And if we look at healthcare, healthcare currently is still running somewhere between 3.5% and 5%, depending on if you're looking at
Yeah.
inpatient or outpatient. And so all of those are telling you that this is what people feel. This is what people are sensing. This is what they're, especially the people are millennials and baby boomers are the two biggest cohorts. That's where they're spending a lot of their money, and then that's going to impact their decisions. Excuse me, around the election time. And I think if you talk about what the Fed cares about, you're mentioning wages. If we look at that super core inflation, which is remember that is the core ex-housing
Yeah.
services employment. That's what Jay Powell says they care about. That's running at 4.8% and has been moving higher each of the last 3 months. And so
Yes.
the inflation the Fed cares about, which is all driven by this consumer perception and wages, is going the wrong way. It is not going lower. It's actually going higher. Um, but that said, I wanted to see what you thought about this one, because this is a model that Bloomberg talked about in an article last week, and they call it their Fed speak model. They use natural language processing technology, and they go back and they look at all the different Fed commentary, and they've done it for an extended period of time. And they when this measure that's a white line here on this chart, when this measure is moving higher, that means the Fed commentary is more hawkish than normal, and when it's moving lower, it's more dovish than normal. Um, and so whether what they're doing versus what they're saying can be two different things, of course, right?
All right.
They might not be moving rates lower, but they might be talking about moving rates lower. And that's kind of what we've seen of late here. And that's really, if you look at it, there was a collapse in this line, this white line, November of last year through April 1st of this year. And that was the Fed's commentary just being far more dovish than normal. And then what I've plotted this against is the forward earnings yield. So that's the inverse of the PE. So it's the earnings divided by the price of the S&P 500. And so that, that's as the Fed's being dovish, this earnings yield is falling, and this plots again pretty well, and so that means that the market is responding. So the PEs of the market are expanding when the
Yeah.
Fed gets dovish, and when the Fed's hawkish, the PEs of the market contract. And so whether the Fed's raising rates or not, the Fed has been very dovish. We saw a little bit of an uptick here into the Fed meeting, but that's come off a little bit. And so the stock market has been responding much more so to the Fed commentary than it has to the actual Fed policy. I don't know how you feel about this, but this to me was pretty interesting when I saw this.
Yes, Rich. This corroborated with one of my recent research about using the NLP, natural language processing, to investigate the Federal Reserve's policy versus the action they undertaken. Lately the Federal Reserve actually did become, as what you have seen, the line here. They actually talk more about the inflation than they actually took action against the inflation. Right at the beginning of this year, apparently we saw some indication that Federal Reserve might actually uh, uh, take, they could actually either cut the rate, or they can hold the rate high for longer. Now, they also thought about, there are a lot of speculation that Federal Reserves might actually hike the interest rate, but they just talk about it without actually taking the real action. So I think that our Federal Reserve is very good at just managing the expectation of the market's perception rather than taking the real action. This is actually very interesting. They're doing the very good management with the language that they use, and especially also Chairman Powell tried to really deliver the information message even over his speech right after the Federal Reserve's minutes release. Sometimes like his talk can move the market. Very interesting. This is what one of my research is about. What actually what are the keywords that actually drive the market movement that within the Chairman Powell's talk. So apparently, the inflation and the wage growth, this is the two keywords, and also the housing, a few of the keywords that we all cover here that actually can drive the market. So in any sentence, without those kind of keywords, that we probably don't see too much of a meaningful market movement. But whenever he actually comments on that, regardless that it's slightly, even though it might be slightly hawkish, then the expectation that the message delivered within the federal statement, that the market would just went down immediately. So we definitely see this is how he changed the expectation. This is very interesting. Apparently, market did actually respond that right now over the past over the last past couple of days, when we see that like no indication Federal Reserve would hike interest rate, which we agree, there's no way that Federal Reserve could hike the interest rate given the current right now the U.S. government debt over the GDP ratio, and especially also the liquidity available, the repo reserve, the latent repo reserve versus the number or the amount over the past couple of years. This indicated that we might actually potentially see some financial liquidity issue. So Federal Reserve has no way they could hike the interest rate. The market respond very positively. just given the situation, given the market concerns about what could potentially happen. Apparently, the move was driven mainly by some institutions, not by retail investors. This is what from the data that what we have seen. Then could actually show the strong confidence over the overall market performance for the rest of the year. But coming back to this point, that we do see some very interesting things how Chairman Powell's managing the wording. This will remain a very interesting topic. Then later on, we can actually maybe come back and discuss further. Once I have more result to share.
Yeah, no, that'd be super interesting, and it doesn't surprise me because even going back to Bernanke, he talked about the communication strategy being a tool in the Fed's toolkit, and so I'm sure the Fed is very well aware of what it says and how that impacts algorithms and how that impacts markets, and so that
Correct.
is definitely something where we can kind of see this.
Yes.
And so I ask, is the Fed policy restrictive? And that's and again another debate that I've been having is that some people say that the Fed policy is very restrictive, and that's why they need to lower rates. And because they're talking about the Fed policy, the actual rate versus the so-called neutral rate, which no one really knows where the neutral rate is, the R
Correct.
star, if you will. Everyone has a guess of where they think it might be, but no one really knows where it is. But I just went and I looked at the Chicago Fed National Financial Conditions Index, or the National Financial Conditions for Credit Index. And this is a measure of financial conditions put out by the Chicago Fed. This is one that the students in my portfolio management class almost always find to be one of the significant measures when they're looking for either growth or inflation. And so
Agree.
it's just very strong measure. And this is a line again. And then for those on the podcast, I apologize, but if you go to our CFA Chicago website, you can see the slides when we post the video. But when this line is rising, that means the conditions are getting tighter. And when this line's falling, that means conditions are getting easier, right? And so if we just go back, we can see COVID, this line spiked higher, and then the Fed stepped in and eased that policy, eased it tremendously into 2021, much lower than we had seen in any point really in the last 10 years. And then it got tighter again in 2022 as the Fed was raising rates, et cetera. And then really from spring of last year until now, it's gotten a lot easier this entire period. And now, I just drew some regression lines on here, and you can see that it's about one standard deviation easier than average. And so that tells me that the Fed isn't really restrictive if the financial conditions are telling us that they're easier. Not mean they're not screaming easier like they were back in 2021, but they're definitely easier than normal and easier than average. And so I don't see where the Fed policy is as restrictive as they say, and people will argue, well, that's this is probably indicative of like the equity markets being higher and credit spreads being tighter, et cetera. To which I would respond, well, of course it is, and higher equity markets and tighter credit spreads are certainly a sign that conditions are easy, and therefore inflation has risk to the upside because people are going to feel comfortable to spend money and companies are going to feel comfortable to borrow money. And so I don't see how this I don't think we should ignore this. I think to me this is telling me that that the Fed really doesn't have again another lever point sign that says the Fed shouldn't really be cutting. What do you think?
Yeah, Rich, definitely. This is financial condition indicator is the one that I was referring to just a few minutes ago, and this actually had become one of the most frequently cited index within the quant community. So most of the quant researcher, as long as they actually cared about the macro, care about what the financial condition would have an impact over the equity market. This is one of the index they are watching very closely. So this has turned out to be a very good index. As we have seen, the liquidity index actually was easing down over the past few years. That actually stimulated, continue to push the equity market, continue to go higher. Another similar index that's telling exactly the same story as what you're talking about is the yield spread between high corporate bond yields versus the Federal uh, Reserve's a standard rate. Now, this typically what we can imagine is like corporate would have a higher risk than the risk-free rate, the confidence over the central banks. Now, as long as if the overall liquidity over the market is actually very tight, we should expect that investor would demand the corporate to pay higher yields, right? Higher yield to compensate the additional risk. But that's exactly not what the case for today. We continue to see the corporate bond yield spread over the risk-free rate, or even 2 years Federal 2 years yield to be still the minimum at it's quite close to the bottom of the one standard deviation. This is still telling us that we don't see too much of the financial condition stress. The Federal Reserve isn't restricted to the extent that market anticipated. I agree with you on that particular sense. And given that situation, that I think this is actually set up a very nice environment or context for the equity market investors to be more optimistic about the outcome for the rest of the year.
Yeah, I would agree with you on that front. And so if we look at, and again, this is another measure, and you're kind of talking, you mentioned the kind of the credit spreads, but
Yes,
this is the one measure where I would argue that maybe you could say the Fed policy is restrictive, and that's if you look at the yield curve. And so here I have the 1 year versus 10 year, and we've talked about this before, that every time this yield curve inverts, we have a recession. I've drawn the recession areas in a shaded red area, and
yes,
we have now gone the longest period of time um, with inverted yield curve. We're going on almost 2 years now, Tony, of
yes.
where the yield curve has been
All
inverted,
right.
and such that people are saying that the yield curve no longer matters. And I would say the yield curve has had a 100% hit rate with a variable lead time. I'm not one to throw in the towel and say the yield curve no longer matters. I think there's been maybe some exogenous things such as pro-cyclical fiscal stimulus that has really kind of diminished the impact of the yield curve. But I still kind of think the yield curve matters. And I guess this is the one front in which you could argue that maybe the Fed policy is restrictive. We don't really see it in the data yet, but maybe this is why we're starting to see the growth start to slow down, even though inflation is staying higher, is because the lagged effects of this yield curve might finally be kicking in, and maybe that's ultimately the sign that the Fed policy is a little bit more restrictive. So I don't think it's entirely clear, but we've talked about this. Have you given up on the yield curve, Tony, or you still think it's a viable indicator?
I haven't given up. Statistically, 100% hit rate. This will not go away, and historically speaking, this time it will not be an exception as well, in my opinion. And what not only just us, I think investors on the Wall Street, Main Street, Federal Reserve is also looking at this by themselves, because what we had, as what you pointed out very clearly, it was actually the moment that when the yield curve inversion actually stopped and disappeared, which is like a Federal Reserve have to actually the short-term rate had to be going down, or the long-term rate have to either going up. So either two situation happens over there to make this like yield curve inversion just inverse or reverse. So it was that moment that then market will start to worry about that we might be heading into the recession. And this year, given the strong expectation from the investors globally and domestically, then any reverse of the inversion curve, yield curve here could stimulate the market's sell off, and simultaneously with the concerns that we might be heading into the recession. So this time it could be the market sell off leading to the recession, not the other way around. This is recession, and whenever that happens, so a lot of people would actually think about what could Federal Reserve did, what could they do to lead us to that situation. A lot of people think about right now, the current situation is quite similar to 1970 or 1975, where when we actually started to see this kind of commodity-driven inflation, and that's why when Chairman Walker has to take a very strong stance. Now, this is why I think we're looking at it a different way. We're looking at when this like a yield curve inversion reverse rather than actually looking at whether how long that we have been into this yield curve inversion. So, you're right that this is so far the longest over the longest period that the yield curve had been inverse historically over the past few times, four times. But now we are actually getting into a different scenario, different situation. If not because of the AI revolution, the generative AI revolution, which is actually is widely adopted as maybe the third revolutionary period that could actually enhance the productivity significantly for the corporation and for each human capital. If not because of that, that um, we could have seen the U.S. economy get into recession way earlier. But with that in play, so this is situation is very complex. We still do have the geopolitical tensions like somewhere else in the Middle East between Ukraine and Russia. Now, the complicated situation here does make the Ukraine inversion and reading slightly complicated. But I agree with you. This is still not the case. People all of the people, I would say, most of the people will still think this is very useful from the quant field. This is still very important as this has to reach to the point that's telling us typically 6 months from now that we would probably might not see the recession going on. But now the general expectation is given after the election, what could come out from the presidential election, this might actually give us a completely different opinion from what we have seen. And any surprise to this could actually cause the market unease. For instance, like the PMI reading release, I think in the past 2 weeks actually give a lot of people the surprise because when we look at the corporate earning remains robust, right? And when we look at the unemployment data, unemployment remains historically low, and then when we actually started to kick in the PMI, which actually came in significantly below the market expectation. This is telling us this lot of information, and the yield curve is still a very important figure to look at.
Yeah, you're absolutely right, and you touched on a few things that I want to get to, but I want to go through the next few slides pretty quickly. But there's an indicator. This one was introduced to me by Ed Yardeni, a well-known market strategist, back in the early 2000s, and he calls it the fundamental stock indicator. And really, what this is it looks at jobless claims, consumer confidence, and the CRB raw industrials prices. And then there's a way to kind of combine those. And what it's really telling you is that the economy leads earnings and earnings lead stocks. And so when the economy is trending higher, the stocks will trend higher and vice versa. And we can see that really from 2000 to 2019, this indicator worked very, very well, right? There's a really good shape where if you knew the trend of this indicator, you had a pretty good idea, excuse me, what the trend of the stock market would be. Now, COVID has kind of confused some of that data, but here's the data since that time. And so there's a little bit of a confusion, volatility from the COVID data, et cetera. But what we can see is that for the most part, the indicator was suggesting that stocks should be a little higher in towards the end of 2022, and sure enough, the stocks headed higher and matched up with this indicator throughout all of last year. And now stocks continued higher, but now this indicator has rolled over really since the start of the year, and is kind of suggesting it's another one is suggesting that the economy, again, looking at jobless claims, looking at consumer confidence, looking at commodity prices, saying the economy is starting to struggle, and this should ultimately weigh on stocks. And you just mentioned the PMI data, and I love the PMI data.
Yes.
I should say the ISM data, the one from the National Association of Purchasing Managers, and not the data from the S&P, the PMI from the S&P, because it just doesn't have a long enough history. But if we look at that data that came out at the end of April,
Mm-hmm.
you mentioned that it was weaker than expected, and the white line is that the weaker than expected ISM came in below 50. It went back below 50. It had been moving higher for the most part this year, and now it's moving back lower. Importantly, I think is that in the last several months, the ratio of new orders to inventories which is
Mhm.
a leading indicator of this leading indicator, that has been rolling over, and that's that was an indicator that really told us things were better than expected all of last year, and that a
Mhm.
lot of people, including myself, really didn't pay enough attention to. And so I'm trying to keep an eye on this, because right now it's giving us a sign that things are actually getting a bit worse. And then the other line that I have on here is the prices paid index. So again, there's a lot of different measures of inflation that we can see out there, but the prices paid index has been moving consistently higher, really since summer of last year, and it's another sign that the prices that businesses are facing that will get passed on to consumers continue to move higher. So this is a sign to me that even though Jay Powell says he doesn't see any stag or any inflation, I kind of look at this data and I see both stag and inflation. So I think stagflation is something that's very much in play here. It's not, we don't have it yet, but it's something that I don't think, looking at this data and looking at the direction of the jobs market, I don't think we can rule out stagflation at this point. I don't know how you feel about that, Tony.
I agree with you, Rich. We cannot rule out the stagflation at this particular moment because, especially this is very interesting about the price index keep actually going up. This actually has been reflected with the most recent earning from the consumer staple company. For instance, even like or consumer discretionary company. For instance, like Marriott reports earning actually significantly below the expectation, which actually typically they measure how people, whether people would actually spend actual money over staying in the hotel, high-end hotel or mid to high-end hotel during the traveling. This is not exactly the case. We see the weaker demand from uh, the traveler, for the consumers overstaying this kind of a high end, or even to have this with the higher like a gas price. Now, U.S. consumer didn't or don't at this particular moment consume like even travel as much as they did compared to the pre-pandemic level. We did start to see the negative impact over the high price and high inflation over the consumer spending behavior in the past quarter. Actually, very interesting. It's like in our last episode, we did discuss multiple things. We think even though CPI actually is an accumulated index or maybe just a change ratio, but what consumer feel, right, is actually the absolute price. It's not relatively the growth of the CPI, the price change. It actually is the price tag that we are paying. We're not paying this 2% the CPI. We're paying the
Yeah,
continuous compound rate of the price. Now, this actually has reached to historically high level, and a lot of consumers feel the pressures of the high gasoline and feel the the pressure of other the normal consuming demand, consuming good. This had not just about the consumer discretionary sector, like even McDonald's feel the pressure, right? This is
yeah,
typically low end. Even and yesterday Distance came out reported the earning. Actually, what we can see is the demand is like overall. This actually measure the how people with the kids actually to spend over the kids' education. This sometimes this has become it's very inelastic. This is actually telling us now the consumer wasn't actually optimistic about their capability or their affordability for a high price. Starbucks is another great example, right?
yeah,
Now, continuously, I showed the very disappointed earning just because of like the high price of the cost. Think about that. Maybe even 5 years ago, when we actually walk in a Starbucks store, buy a cup of coffee, it was like even for rosy coffee, dark roast Joe, it was maybe just $1.7 or
yeah,
roughly 1.5, 1.7. Now it's a $3 either.
yeah. It's double for sure. And you're right. You're absolutely right. that we saw during the financial crisis, as bad as things were, people didn't give up their Starbucks. We saw in
Correct.
COVID, we saw during COVID, as bad as things were, people didn't give up their Starbucks. But what do we see last quarter from Starbucks? People are giving up their Starbucks because the
Exactly.
inflation is taking a bite. And so it wasn't the lack of growth that get people to give up their Starbucks. It was inflation that's getting people to give up their Starbucks. And you're right, they're trading down to cheaper brands, et cetera, because the price
Exactly.
has just gone
Exactly.
up
Yeah.
too much for sure.
Correct.
Well, and on the same front, this is the quarterly data from GDP. And, I'm not a huge fan of GDP, but I think it's just another measure to look at. But what we
Correct.
saw from the quarterly data that came out at the end of April, early May, was that the growth rate was lower than expected at 1.6%, and the inflation rate was higher than expected at 3.1%. So another sign to me that we're seeing this kind of stagflation that Jay doesn't see, but I see it in the data. That
Yeah.
said, earnings, I mean, I'll go through these quickly, but earnings are saying things are all good, right? If we look at the earnings surprise, and this is, we're more than 80% done with earnings at this point. And
Hmm.
for the S&P 500, we can see that the earnings surprise is close to 9% this quarter, which is a really high number. It's higher than we've had in the last several quarters. So the earnings surprise has been really, really good. But I would point to a couple of things that are maybe not as good on this, and that is that the sales surprise has only been about 1%. So really companies aren't surprising on the top line, they're surprising on the bottom line, right?
Hmm. Hmm.
And the other thing I would point out is in the lower right here is the stock's reaction to these better than expected earnings numbers. And the stocks collectively are essentially reacting negatively. Now they're not reacting, excuse me, not reacting negatively to positive earnings surprises. They're reacting negatively that even though companies are beating earnings, the company commentary has not been that positive on a forward-looking basis. So even where companies put up good numbers, the commentary hasn't been that good about what things will look like going forward. And so therefore the stocks are in general are not responding too favorably. Of course, we can point to some of the bigger Mag 7 names like Apple, et cetera, Meta, Google put up better than expected numbers and the stocks rallied. But for the most part, when we look at in aggregate across the market, stocks are not responding too favorably to these good earnings, even though earnings have been quite good. And maybe that some of it is because if we look at the actual growth numbers, the growth numbers in earnings are only about 5%, and the growth numbers in sales are about 4%. And so the growth, and it's a little bit more mixed picture. If you see the earning, if I go back, the earning surprise was positive across the board, across every sector had positive earning surprises. But in terms of earnings growth, we're not seeing the same sort of across the board earnings growth, in a number of different sectors, et cetera. And so I think the picture is a little bit more mixed on the absolute growth numbers. And we can see on a forward looking basis, if I look in that lower left, that orange line tells us where we are right now. If we look at the earnings growth expectations for the next 4 quarters, they are much, much higher than they are this quarter, right? They're approaching double digits expectations of earnings growth for the S&P for each of the next 4 quarters. And so the hurdle rate is looking pretty strong for the next 4 quarters, which is I think a reason why these stocks are not responding favorably to better than expected earnings this quarter. Now, one place where we've seen really good earnings growth is in the NASDAQ, right? If we look at it clearly, consumer discretionary within the NASDAQ, technology within the NASDAQ, biotech, communications are all putting up really, really strong earnings growth. Maybe not as strong as the last couple quarters, but at 20% plus, the earnings growth is really strong. And while the hurdle rate at 15% or more for the next 4 quarters is pretty high, we're seeing the fact that the Nasdaq has been able kind of to deliver in each of the last few quarters this number. And so that I think this is why we're seeing a little bit more of the people moving back into the Nasdaq post this earnings period because you're seeing the absolute numbers just look a lot more favorable. Is that kind of how you see it, Tony?
Yes, Rich. If not because we are running out of time, probably we can actually spend the whole day discussing about this two most important graphs. Like because there's
Yeah.
two pictures are telling a lot of information. This is what's really happening and what's really driving the market movements over the past few weeks during the earnings season. As what you pointed out, that sales growth, most of the company actually 70 more than 70% of the company, which actually reported better than analyst expectations, like but in terms of both top and bottom line revenue and earning per share earning growth. This is a very good number and still meet the historically average. Now, especially when we look at this, the divergence between the sales growth versus the earning growth is that we see two different picture. One picture is telling us company actually continue to actually deliver more of earning per share surprise rather than the sale growth surprise. That's telling us that the managements are taking the cost management approach. So instead of actually driving out the growth of the sales or revenue, they actually take a more of the restricted approach over the SG&A, and by adopting many approaches that we typically see, like laying off employee, cutting off the salary. Now, in the latest round, Tesla was one of the most I think apparent the company which actually lay off a significant amount of their labor force across the board. Google, another major high tech company, continued to restructure the company, and they even lay off the core development group internally. So this actually has been reflected over their financial report as well. This is telling me the companies like trying to actually meet the demand from Wall Street might actually continue to lay off more of the
Yeah.
employees across the board. And this coincided together with the AI development. Now, generative AI, is actually a revolutionary force in terms of technology, which can help the company continue to raise the productivity and simultaneously enabling them to do the cost cutting. So this might actually put some pressures over the labor market, which we still see the very strong labor market in a way that a lot of people feel extremely surprised that now, given what had happened, and analysts, I think, over the past few days has raised their expectation as what you have assumed, like for the rest of the year, even in the next 4 quarters over the year. This is actually a strong sign for us. So we do read this figures very closely, and especially once we if we have more time, maybe in next 2 weeks, that we can actually go slightly deeper into what really means into each individual sector. But that's actually corroborated with what the company's earning reports very closely, and also what had driving the market.
Yeah, you're absolutely right. And then maybe in a couple of weeks we will go and warn earnings because we'll have NVIDIA earnings at that point too.
All right.
I just want to go through a few more slides really quickly. I know we're a little bit out of time here, but this kind of maybe suggests this is something we talked about before, the rotation of funds, and we had seen money rotating out of technology and into energy and materials. Will that continue, or are these earnings suggestive that maybe we'll start to see that rotation start to stall out a little bit? If we look at the rotation of other assets, we are seeing the kind of the momentum, high tech, high growth parts of the asset classes struggling, whereas we're seeing these commodities moving through from the improving into the leading category. So we're still seeing the commodities in the leading category. We're seeing the things like Nasdaq, momentum, cryptocurrency moving into the weakening, if not lagging category. So we're still seeing that rotation. I wonder how long that could last. From a factor standpoint, looking at it, momentum is still the number one factor in the year to date. So momentum, large cap, low volatility, growth type of names are still where people want to be, though maybe over the course of what we might be seeing that a little bit of a transition here, and in stagflation, it's definitely not where you necessarily want to be. And so I think that'll be interesting to see. Keep an eye on how this moves as well, kind of going forward. And then ultimately, I want to kind of end with say, what we've been talking about a lot is inflation and how that impacts Fed policy and the commodity prices, which we've talked about before. And when you talk about commodity prices, Everyone wants to just talk about oil, and oil's definitely come off the peak. And I mean, I know there's some geopolitical premium in there that may have come out or may not come out, but it's still plus $80 plus or minus a few dollars. But this raw industrials commodity index, which ultimately is the one that leads inflation, which is ultimately the one that leads Fed policy because it's the cost that companies face that they have to pass on to customers, continues
Mhm.
to be in this channel since November of last year, where it's moving higher. And I still just think that this means the Fed is not going to be out of play. And that's going to be, it makes it a tougher period, even though I can see all the reasons that we want to own stocks here. And I'm still long some stocks too, but I want to take out some insurance because I think higher for longer for Fed is still what we're looking at. I'll leave the last words for you, Tony.
Yeah, Rich, even though we run out of time, but I still want to actually comment on one of the slide, the sector rotation globally. Uh, That's
Yep.
yes. This is I think this within this graph, this recent strength graph show very important things other than what you have been talking about, the energy, the commodity. This is in the top FXI. This
Yep.
actually represent the Chinese large cap corporations like a index. Now this could by itself maybe could become our topic um in the next episode because we we start to see the FXI, the leading the indicator for consisting of many of large cap corporation of the China's start to get actually getting stronger and now getting into the leading space with the strong rebounds over the past 1 week only. It's very strong. And even Goldman Sachs and JP Morgan continue to upgrade it, the their prospects over investment into the China. That's all for all the known reasons because of the tension between the two largest economy in the world, US and China, over some economic disputes and some industrial policy dispute. Now, the US financial market of the Chinese financial market has seen depressed for quite some time. And it was just starting in the past 2 weeks that we started to see that actually it was actually taking some lead over the performance within the global financial perspective. This actually could be, come up for lots of reasons, and a lot of institutional investors still think this might be transitional, but for us, we just want maybe our audience also pay attention to the development of the FX side, the Chinese uh, market in the Hong Kong Stock Exchange and also the large cap FXI ETF here in the US. This could potentially become one of the maybe risk diversified tools going forward, whereas the Federal Reserve keeping the higher for longer monetary policies, which most likely will be the case for the rest of the year. That this might give us some of the risk diverse benefit.
Yeah, I would agree with you, Tony. And then I think that's a great place to end. That maybe in a couple of weeks when we get back together, we'll get a little bit more of a deep dive on AI because we'll have some NVIDIA earnings and we'll be able to talk about that. But I think you're right, talking about what we're seeing in terms of in China in particular, second largest economy, very large market that a lot of investors had kind of gotten out of and not, and many say that they don't want to go back to, but perhaps there's some interesting things going on
Yes,
in that
yes,
market as well. So we've
correct.
kept everyone for a very long time here today. Thanks for if you stuck with us. Thanks for sticking with us. Again, we'll be back in a couple of weeks to cover more, but for now, we wanted to just kind of end it there. And thanks for joining on all of the macro that matters here in the Macro Matters podcast. Tony, thanks again for joining me. I hope you enjoy the end of the semester, get through all your grading pretty easily,
Yeah,
and start to
thank you,
enjoy
Rich.
some summer.
Yeah, definitely, definitely. We would enjoy reading the maybe the investment thesis that's submitted from a lot of talented people here. Hopefully the same for you. That will come back maybe in 2 weeks.
Sounds good. I look forward to it. Thanks,
Yeah,
everyone.
thank you.